Hello and welcome to this special report here at XM.com. We'll be taking a look at the trading process of a fictional gold trader and the key events that most determine the outcome of such trades. I'm Maria Pachardis, and joining me is investment analyst Achilleas Georgopoulos. So Achilleas, can you tell us in a nutshell what traders can learn from this special report?
Good morning, Maria. Being a retail trader is an extremely challenging and complicated endeavor. So we decided to run a fictional trading account, more or less a simulation, covering the day-to-day trading aspects. We started our fictional account with $10,000. Gold was selected as the single trade instrument, and the plan was to trade every day. However, we opened a position at the start of the trading session and we closed the position at the end of the trading session, so as to avoid overnight, essentially, charges. A simple strategy was selected, which was every Monday we will sell gold and then buy gold every other working day. Therefore, we had one sell order per week on Mondays, and then we had 4 buy orders per week, Tuesday to Friday. Considering the 5% margin requirement, which of course our traders can find at the webpage, we reached a conclusion that based on the margin, we were going to buy on a daily basis 0.1 standard lots of gold. That was set, and we didn't change it, we kept it constant during this trading exercise. Stop losses and take profit targets were essentially used on every trade, and we cannot highlight how important especially the stop losses are. Stop losses were set about 1.5% of the running amount of our fictional portfolio, and the target was to take profit was about 2 times the stop loss amount. Table 1 in the preview, of course, presents the full details for the setup of this fictional portfolio.
So what are the results of this fictional trading account?
Yes, the exercise produced some interesting results. The fictional portfolio executed 258 trades, with success being around 49%, more or less 1 in 2 trades were positive. The end amount was $13,313, more or less a 31.3% return. We have to highlight that in certain days, stop losses essentially protected the fictional portfolio from suffering much greater losses. Also important is that during 2023, gold had a good year, so it finished the year 50% higher. This means that if someone bought at the first day of 2023 gold and held that during 2023, they would earn 50%. However, the exercise we executed with buying every day resulted in a much stronger return of 31.3%.
And finally, which events impacted the fictional trades most?
This trading exercise also allowed us to essentially check which market events caused the biggest volatility in gold in 2023. Understandably, and as widely expected, central bank meetings, days when we had quite a few Fed speakers, and of course the US labor market statistics, non-farm payrolls as we noted, were essentially the top 3 reasons that gold hit either the stop losses or the take profit targets. And just to add, surprisingly, the days when we had the releases of the US CPI and the US PCE did not really make the list with the top reasons for causing volatility in gold in 2023.
Achilleas, thanks so much. And thanks for joining us for this special report here at XM.com.